The Canadian government is trying to prop up the housing market. I'm going to talk about the two most obvious ways that they're doing this, with a primary focus on the new 30-year amortization for first-time buyers who are buying brand new houses in Canada. Watch to the end of this video because I'm going to do a breakdown on the difference of costs in a 25 versus a 30-year amortization. And I'm also going to talk in depth about how this is actually a policy designed for the construction industry, not really for first-time home buyers. I'm going to discuss what this means for buyers of that type of product, what this means for the market, what I think their intention is behind this policy, which is to stimulate new construction. Before we do that, I figured to take the time to introduce myself. My name is Daniel Foch. I'm a broker and director of economic research at a company called Real Estate in Toronto. I still do buy and sell work for a lot of clients in the real estate space. I feel like it's a good way to keep my pencil sharp. I host Canada's #1 real estate podcast. We release 2 episodes per week, so I spend a lot of time researching and analyzing current trends that are happening in the real estate market and are important to real estate investors in Canada. I also run an online coaching with 2 great guys. It's called Realist.ca. You can see the link up here. And the link is also at the top of the notes below. And I also run a content creation community with Adam DC, who is one of the top creative directors for real estate professionals in Canada. Works with a lot of the top agents. And so if you're a real estate professional looking to level up your game and create content like what I'm doing here at scale, we'd love to see you in there. As always, a greater length version of this video will be available in the Realist Premium course. If you head over to the Classroom tab, you'll see hundreds of hours of recordings available here. We also have a full calendar of regular weekly masterminds and deal workshops where we actually take in real properties that are listed on the market and we analyze them together as a group. This is a really good way to get the reps in of analyzing a lot of deals because that's what's necessary to become a good real estate investor. A lot of people think you just find a good deal. The reality is you become a good investor and then you create a good investment. Anyway, enough of the pitches. I'm going to head over to my Substack where I recently published this analysis. It says the government is trying to prop up the housing market. I also published it on LinkedIn. And I quickly went through what makes me feel that the Canadian government is trying to prop up the housing market. The first piece being that they're offering 30-year mortgages for first-time buyers if they buy a brand new house. The condition being if they buy a brand new house. So it's very clear where the policy is aimed on stimulating demand for brand new homes. The next piece is the government is exercising what I would call yield curve control on insured mortgage rates by becoming the largest buyer of Canada mortgage bonds and increasing the CMHC capital pool by 50% or $20 billion last year. In the article, I mentioned how I can totally empathize with why the government would want to prop up the housing market. Nobody wants a housing crash on their record, especially not heading into election, but also it could potentially be the right thing to do. It's sort of like that kill one, maybe save 1,000 concept where, especially in Canada, you have 66% homeownership. And so you do technically represent the majority when you're making policies that support homeowners. The big problem here is, from my perspective, is that we're solving a problem in Canada, which is a debt problem. It's not any other type of problem. In Canada, we have an economy that has too high of a household indebtedness, and people are paying more than the production cost of a rental unit to keep that rental unit in existence. This is where you see like cash flow negative condos, and the difference there would be perceived as an economic rent, which would be given to the bank. And so the banks really are the ones who benefit most from this type of environment. As we can see here, the Canada 5-year bond yield, which is the primary underlying pricing mechanism of the 5-year fixed mortgage rate, hasn't really changed since October of last year, yet interest rates are not priced the same as they were during that period of time. The banks are likely pocketing the increase in rates as a risk premium because the market is far riskier right now. The challenge is buyers are continuing to hold these overvalued properties rather than selling them at a loss because they think that the market or rates are going to come down and they have a positive forward-looking perspective on the market. But the reality here is that this is killing Canadians. We've seen the biggest, basically our disposable income after monthly debt payments has fallen off of a cliff here. This comes from M3 Development Management's monthly newsletter. So my perspective is that the government is trying to win the vote of the youth where they've lost a lot of vote. You know, I think they fared really well with the younger generation in the past couple of elections. Legalizing cannabis probably was the biggest policy that really rallied the support of that group. But now they've kind of really suck the life out of an entire generation by making it utterly unaffordable for us to exist, and especially to realize the Canadian dream of homeownership. And so they want to change that by making it so first-time homebuyers in Canada can access 30-year mortgage amortizations. It seems like their goal would be to make the younger voters less angry with them, but also beef up pre-construction purchases, which are really the only way houses are going to get built in our current economic model. We know that housing starts are falling in Canada right now. So here you can see just the federal vote intent by age. In the 18 to 44 range, they're polling below 20% for all of these categories, with the NDP and Conservatives way ahead of them. And so, I mean, this chart would tell you that they're basically one generation away from being third-party status if they don't see some serious change. And I think that even when young people had an opportunity to buy, they were in such a volatile market. And the goal of the government here should be to stabilize the housing market, not to continually introduce inflationary, deflationary policies. A market that trades sideways would be a very healthy market for people. In 2015, we saw house prices go up double digits. 2016, same thing. 2017, they crashed. 2020, 2021, they went up double digits. And then 2022, they crashed. And so a lot of young Canadians really want to get off this roller coaster. We just want to have a fair chance at being able to buy a house. RBC put out this great report in 2023 showing how young people are especially at risk because we've accumulated the most debt compared to the older generations. And at the same time, we've benefited least from that debt. Like even young Canadians who are taking on debt to buy houses, they haven't owned those houses as long as the older generations who have seen long-term capital appreciation take place, whereas young generations have owned them maybe for 5 years, where they saw double-digit increases, double-digit drops, and they've been on that roller coaster. So they really haven't been able to benefit from the asset inflation that older generations have benefited from. So you would assume that the government will try anything to make this housing situation less painful for younger generations, because it's so glaringly obvious that we're in trouble here. And I think that the only way that they're going to have any chance at getting votes from this generation is by giving them a leg up on the housing market. The problem I have with this is that it's the opposite of a deferral of gratification. You get a short-term gain for long-term pain. So you can see that there's obviously a material difference in your mortgage payment if you look at a 25-year versus a 30-year amortization. So your mortgage payment would drop from $2,900 to $2,700, give or take. And so because most people qualify for mortgages on debt service ratios, this would increase the amount of buying power they would have, because the amount of money they're spending on a monthly basis as a percentage of their income would go down, which means that they can qualify for more. So it increases the buying power of first-time home buyers immediately by giving them this increase in amortization. The problem that they don't really talk about is the cost. And so if you look at just over your first mortgage term, you would pay $117,000 in interest over the 25-year AM and $118,000 in interest over the 30-year amortization. Over the life of a mortgage, this is where it really compounds. You're paying almost $100,000 more in interest, from $372,000 to $460,000. You're paying more interest on more money for a longer period of time. So you would pay about 1.5% more interest over the course of your first mortgage term, but it would cost you about 23% more interest over the life of your mortgage, which is a material difference. Earlier on, I mentioned how I can understand why the government would want to make a policy for first-time homebuyers, and there's economic benefit to that. I think the biggest reason is, according to the Bank of Canada here, you can see that first-time homebuyers generally account for about half of all home purchases in Canada. A lot of people are like, that doesn't make any sense, but they're not half of homeowners, they're half of home buyers. And it makes a ton of sense because your repeat home buyers already own a house, so they don't need to be a buyer, and investors are not necessarily a huge share of the market. This chart, by the way, comes from, if you search first-time home buyers and Bank of Canada, they have this housing demand in Canada. It's a 2022 publication, but they show first-time home buyers. I made a derivative chart of this chart here. The share of home purchases by first-time buyers has declined since 2015. And the way I did it was, it started at 0 and it grew. It went viral on TikTok, and you can see it in my YouTube shorts here. But it kind of was like a chart crime, because it's the relative change, and so made it look like first-time buyers were non-existent. But this chart is also a chart crime because they use dual axes. So technically, this first-time buyers line should actually be way up at the top because I just showed you that they're 50% basically of the market. And while investors and repeat home buyers are increasing as a total share, first-time home buyers still are the largest group of home buyers. So all of that to say that if you want to move the needle on something to prop up the housing market, you would deliver it through first-time home buyers, not only because they're the biggest group of buyers, but also because they're the least rational buyers. And I hate to say this, but when you're inexperienced, if you're an inexperienced buyer, you're more likely to be an irrational buyer. I think the spirit of this extended amortization is to give first-time buyers the ability to have access to this 30-year amortization. The challenge is that so many first-time buyers can't even qualify for new homes simply because they don't have the deposit required. So your typical deposit on a new home is like 15 to 20% at a minimum. Naturally, you would want to say, well, this could lead to builders reducing deposits. But the reality is, I mean, if we look at how projects are financed in the Canadian market, there's really no room for developers to do that. So developers actually use deposits as part of what's called their capital stack to finance their projects. So they actually depend on purchasers to make projects viable. You can see here in this chart, this was posted by Well-Grounded Real Estate and Oak Bank on LinkedIn. There's a link to it in the Substack. But you can see here how in a condo development, the yellow bar here, the deposits, is larger than both the land purchase price and the cash required from the developer. And so developers can't really reduce those deposits. And the other reason is because in order to access those deposits, they use something called the Westmount Guarantee, which basically allows builders to access deposit capital for project financing. And currently, if you want to understand the scale of this, they have $5.53 billion of active deposit insurance facilities and $28.5 billion in purchaser deposits working for developers right now. This insurance allows developers to integrate those deposits as part of their capital stack. They also typically have to hit a pre-sale target for construction financing, typically around 70%. Some developers are buying down that target with equity. And so pre-construction demand is fundamental to getting housing starts created in the built for sale environment. And a lot of people say, oh, like purpose-built rental. This same illustration here also shows how in a purpose-built rental scenario, a developer would have to have 35% equity rather than 15% equity. And so the equity requirement is way bigger. And a lot of developers just don't have that kind of cash. Or the ROE, the return on that equity, is so low on a purpose-built rental project that they're disincentivized to do it. They'd rather just sit on the land and wait for the build for sale market to recover. So it's obvious here that the government is trying to basically use first-time homebuyer demand or stimulate first-time homebuyer demand to offset this huge loss that we're seeing in new construction or pre-construction sales. New construction sales are trending about 75% below their long-term average right now. And this is because you don't have investors lining up to lose money on cash flow negative properties. So before, you would often have investors, a lot of foreign capital, come in and buy these units off of developers, and then they would rent them out and they would be willing to absorb a cash flow negative. I think Urbanation put out that something like 50% of pre-construction condo closings were cash flow negative on rental. They were willing to do that because they felt the value was going to go up, and that depended on interest rates going down. Now all of a sudden we're in a scenario where values aren't going up and interest rates aren't going down, so the capital cost of them holding those units is going up and the value of those units is going down. And so you don't have investors who are lining up to buy and lose money on pre-construction. If you're the government, where would you try and replace that demand with? My perspective is the same as the government's perspective: the biggest group of buyers, first-time buyers. And so this is a policy lever in which it seems like it's a leg up for home buyers, but it's really a leg up for the new construction industry. And to be honest with you, it's a damn necessary leg up for the new construction industry, because if there's any systemic risk in the Canadian real estate market, it is within our new construction pipeline at the moment.